What is a market structure shift and how to identify them? This is the third video of the private mentorship for the Iron Minds. And so many people requested this video because they don't understand how to really identify a valid market structure shift. And that's what we are going to cover in this video. So let's start. First of all, let's have some general information to get everyone up to date. A market structure shift occurs when the price action deviates from the current trend, creating a temporary change in market sentiment. This is different from a market structure break, which signifies a long-term trend reversal. For example, if the market has been in a downtrend and then shows a shift in market structure, it means there is a short-term bullish sentiment, but it doesn't necessarily indicate a long-term uptrend. So what does that actually mean? Well, it's very simple. So a market structure shift just lets you know that the market is now going to turn into the other direction for a short-term correction. So let's say we've been bearish for a whole London session. And then we have a market structure shift during New York AM session. So we can expect a New York reversal to the upside, right? And that's what a market structure shift really signifies. And that's why the ICT 2022 model or the ICT silver bullet are all bonded with a market structure shift, because without the market structure shift, there is no real entry. So now let's talk about swing highs and lows, because without swing highs and lows, there wouldn't be any market structure shift, because a swing high and a swing low creates the market structure shift. So a swing high is very simple. It is identified by a candle that has a lower high on both sides. So it looks like a small pyramid. There are three candles, and there is a low, a high, and a low again. So two lower lows on both sides of the candle. And a swing low is identified by a candle that has higher lows on both sides. So it is a higher low, a low, and a higher low, and that forms that swing low. So this looks like that on the chart. So very simple. You can see the candle number one is our first higher low, and then the candle number two is our actual low, and the candle number three is our higher low. So we have two higher lows. So number one and number three are higher lows, and then we have number two, which forms the actual low. And now what you see there is our swing low. Exactly, that's our swing low. And the same thing goes for a bullish swing high. It is just the other way around. But yeah, so you can see number one and three are higher lows, and then number two is the actual low. Now let's talk about displacement. That's our third and last component when it comes to actually identifying and finding these market structure shifts, because a displacement is often misunderstood. A displacement is time-based, and a displacement only occurs when the time is right. And the times where the displacement occurs are very simple. It is during the ICT silver bullet times. So 3 to 4 a.m. New York time, 10 to 11 a.m. New York time, 2 to 3 p.m. New York time. During these 3 hours, there will always be a displacement. Now, a displacement is our last component when it comes to actually building up that market structure shift, because that is the candle that forms the fair value gap that you will take as your entry later on. So the analogy ICT uses is very simple, and I always tell it to every trader that asks me, what is a displacement, what is a market structure shift? And I always tell them it's like an elephant falling into a children's swimming pool. A elephant is very big, very massive, very dominant, and a children's swimming pool is very small. There's literally no place for this elephant. And let's say you throw this big elephant from like 30 meters into this pool. What happens? It's like a big drop, a big fall, a dominant fall, and the pool will probably explode. And that's what a displacement really is. A displacement is a fast and obvious move taking out either a swing high or a swing low. So very important here. A displacement happens after we form the swing high or swing low, and then we have this big dominant candle taking out that swing high or swing low. And we want that to close below. Let's go back below number 2. Then it's a valid displacement with a market structure shift. That's our market structure shift. So like once we really close below this swing low, we have a market structure shift. Now, let's take a look at it at the chart. As you can see here, now let's say we are bearish. We swept a big buy side liquidity pool, right? Now we want to see price form a swing low first. As you can see marked out perfectly, we formed a swing low. Now we want the market to take out that swing low to create this market structure shift so we can enter on the fair value gap, right? So now we wait until we have this dominant move taking out that swing low. Now as you can see, shaded in red is our dominant move taking out the swing low. It has to be a very big candle, very massive candle, like literally no wicks, just a beefy candle, as ICT said always in his live streams, a beefy candle taking out that swing low. And with that swing low being taken out, a fair value gap will form because this massive candle, and then a next candle will open and will leave this gap. And this gap will then be traded into, as you can see here on the chart, this small up move is just a retracement into the fair value gap, and then it will sell off of this fair value gap. Now, this is all time-based. Remember, always look for these setups during 3 to 4 a.m. New York time, 10 to 11 a.m. New York time, and 2 to 3 p.m. New York time. Because during these hours, there will always be this setup forming. And you need to understand where the real market structure shift is, where the real dominant move is that will take out either a swing high or swing low, because that's your displacement where your fair value gap will form. And you need to choose the right fair value gap. So that's why understanding market structure shifts, understanding displacements, understanding swing lows and swing highs is very important. So your task to really understand this is go into your charts and go back test these 3 hours and always look for the swing low or swing high, and then for this dominant move taking out that swing low or swing high, and then mark it out as a market structure shift. That's your training for these couple of weeks to really start seeing this, because with time and practice you will start seeing these market structure shifts occur without even looking for them, because you will see, all right, we swept the liquidity pool, now we have a swing high or a swing low, all right, now this big move taking out the swing high is a market structure shift, and then I will enter on the fair value gap. So that's your practice to really understand market structure shift. I hope you enjoyed the lessons. Until next time, be safe.